Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. On the next 25 minutes, we'll talk all about mutual funds, a few key aspects to be discussed with both of our experts. We will predominantly talk about thematic funds, and in that too, thematic or cyclical funds, if you can call them that. I'm actually using a set of funds which are thematic, but by very nature are cyclical in nature, and trying to ask both our experts whether it's a great time to invest into funds which have a higher infrastructure / manufacturing focus. And then, of course, we will talk about floater funds. Why is it that they're attracting so much of money? We will talk about whether or not you should apply to the Balance Advantage Fund from the SBI stable. And of course, maybe a couple of recommendations on international funds as well. So lots packed in the next 25 minutes. Let's get our experts on board. They need no introduction. With us, Kalpen, Parek, of course. Thank you so much, Kalpen, for joining in. Pleasure having you as always. And joining us on the show for the second time, Salonee, Sanghvi of My Wealth Guide. Salonee, great having you. Thanks for being here. Okay, so let's start off with the first topic at hand. Kalpen, wanted to understand from you, cyclical funds. A lot of people have now started talking about whether this could be similar to the great infrastructure cycle that we saw in the decade of 2000 to 2010, and whether it is prudent to take an exposure to infrastructure funds which are by nature. What are your thoughts? Why or why not?
Okay, to start with, Niraj, first of all, thanks for inviting me. Number two, our minds are wired to look for comparisons of the past because we are anchored. And in fact, the 2003 to 2008 moments were probably once in a lifetime. We hope we get that cycle again when earnings at large grew at 30% CAGR for 5 long years. The Nifty itself went up 7 times. The small cap index went up 15 times. So those type of comparisons are always good anchors to know about. But I don't think we can conclusively say that it is going to be repeat of the same. It is easy to say that to attract money, but I think we still are far away because the global growth cycle, the India growth cycle, none of it is similar to what we had seen that moment. Yet, what I want to say is that, two of the largest democracies on earth, US and India, both have decided to pivot their investments aggressively on the infrastructure side. See, every government has a 5-year plan. In India, we have a 5-year expenditure plan. And depending on the priorities and the cycle in which we are in, the government decides whether we want to invest in infrastructure aggressively or we want to invest with consumers directly. And that determines the spending pattern. As we have observed in the last 6-8 months, when US, the new president came on board, and likewise, India, both continue to say that for durability of our growth cycle, it is important that we invest capital prudently in the infrastructure space. And just to give you some data points, US on a $22 trillion size economy has announced a $4 trillion investment plan between hard infrastructure and soft infrastructure. India on a $3 trillion size GDP has announced a $1.5 trillion investment plan over the next 5 to 6 years. Now, of course, one can debate that announcements are one part and the actual materialization of that takes time. But these are very large numbers, and this is giving a reasonable amount of confidence and hope that we will see more capital coming in this space and we will see more investments happening. And if coupled with the right investment framework, this could be an interesting space to evaluate for the next 5 years. But I would still not want to compare with the last cycle because those were very different heady days. And that cycle started almost at 10 PE multiple. We are already today at 25, 30 PE multiple. So both have a very different context.
Yeah. No, but okay, leave comparisons aside of whether the returns will be or akin to what happened in that cycle. But do you reckon that there is reasonable comfort by virtue of the numbers that we're talking about and the focus towards job creation, so on and so forth, that there's a high probability that investing in this space could turn out to be beneficial, similar to the last time, or no?
Sure. Fair point. I think very valid point, Niraj. I think we are optimistic. In fact, we have a fund called DSP Tiger, which was very popular in those days, and then it had a reasonably long patch of below average performance because the category itself struggled. But around 15 months back, we asked this question that irrespective of the category, what can we do to ensure that we have the best companies of that segment in the portfolio, and then contextualize it to the current cycle. So in that cycle, you had long gestation infrastructure projects which were getting most of the capital. Banks were expanding balance sheets, so banks were a large part of the portfolio. But we tweaked and we redesigned the fund completely, and we repositioned and relaunched it in December last year. We've not made too much of noise around it because we want to ensure that performance stabilizes and improves. But we have redesigned the whole fund as a fund focused on engineering companies, on manufacturing companies, on industrials, on companies which are automating aggressively, on core sector. We've eliminated the lending part of the portfolio. So in old days, the portfolio had 25% in corporate banks, but we said that let us keep this fund as a fund with low leverage. Basically, most companies in the portfolio will have very low leverage. And the moment you take away leverage, the durability of the portfolio enhances. The risk of the portfolio comes down. It may compromise returns to some extent, but you don't have balance sheet risk the moment leverage is killed. So high ROE businesses, but mainly in these sectors. And there is a negative list of no IT stocks, no pharma stocks, no consumer stocks, and no banking stocks. So that's the way we've designed the fund. And we'll be talking a lot more about it in times to come. But that reflects our optimism that this is a theme which merits meaningful focus. And then just one more data point I'll give. In the last cycle, the companies which are today in the portfolio from the segments or the subsectors, they contributed to around 65% of the index then. Today, that number has come down to 20. So even the mainstream indices don't own these segments extensively. To give an example, Tata Steel today, so there is no steel stock in the Nifty index, for example, whereas 50% of incremental revenue or profits in the next 12 months is coming from energy and metal stocks. So I think things are changing. There is a debate whether this is going to last long or not, but we are optimistic, we are hopeful that there are opportunities in this space, and we'll talk more about it.
Well, I certainly hope that markets and the gains give you a chance to talk more about it. And it'd be interesting to look at this fund. Salonee, have you looked at some of the cyclical funds which have this infrastructure focus? And are you guys going out and advising your clients to buy into any of them? Why or why not?
So we have, as Kalpen mentioned, we have definitely looked at cyclicals. Cyclicals are very highly correlated to economic growth. So they deliver extremely good returns if the economy does well, and perform poorly if the economy doesn't do as well. And we've actually not seen cyclicals do much in the last 10 years since the capex cycle peaked in 2011. Currently, with low interest rates, sufficient capital in the system, and deleveraged corporate balance sheets, I feel that we're on the cusp of a large capex cycle, which right now is currently driven predominantly by the government spending on infrastructure. And another tailwind would be once the private sector steps in and the capex picks up there. We've also seen a large increase in commodity prices globally. That being said, a lot of large cap and FLEXICAP funds already have 15 to 25% exposure to cyclicals, excluding financials. So a separate fund for cyclicals may not be necessary for most investors. I would recommend it for very aggressive investors who are okay with the risk and the volatility and are able to time it, because timing is very important, especially for cyclical funds. So it could form a part of the investor's satellite portfolio.
Okay. And what funds, Salonee? I mean, give a couple of names maybe, and they need not be from the DSP. Is a very popular fund, but it may not be necessarily Tiger. But if you can tell us one or two funds which you believe are good for people to invest into in this part.
Right. So actually, DSP Tiger is one of the funds that we look at in the sector. I won't speak about that since Kalpen has already spoken about that extensively. Another fund that I like in the sector is the Invesco India INFRA Fund, which was launched in 2007 and is managed by Nilesh Shah. This basically delivered a CAGR of around 15% versus 11.5% for the category over the last 5 years, and has a substantial holding of industrials in the portfolio.
Okay, well taken. Thanks for that, Salonee. Now, so viewers, I hope you got some sense about thematic funds and particularly infra funds. A lot of conversations have happened. But this was just so topical looking at all the interest around it. In fact, speaking of interest, Kalpen, a word on floater funds. They seem to be attracting fair bit of attention, fair bit of money to our money, and a
So,
fair bit of
Neeraj,
queries that have come to us for example. So what are these and what are your opinion there? Yeah.
Neeraj, there is a category called floater amongst many categories in the fixed income space. But our observation is that most of these are low duration, 6 month, 1 year assets, which mature. So automatically, as they mature, they can be reinvested back at the prevailing interest rate 6 months or 1 year down the line. So they are not floater in design, but they end up being floating rate because the maturities are very short. We launched a floating rate fund in the month of March called the DSP Floater. And we have seen early interest in that because on one hand, interest rates have come down. We've seen a very big cycle where the 10-year government bond peaked at 9.5% in 2013-14, and today is at roughly 6%. On the other hand, overnight rates are at 3.3, 3.4. Money market rates are at 3.5 to 4%. So we've seen a huge rate cycle globally as well as in India. On the other hand, all governments globally, again, as well as in India, want to spend a lot of money, and deficits are likely to be much higher than what we have seen in the past. So if you map these two things together, there is a probability that in the next year or two, interest rates would be higher than where they are today, number one. Number two, currently we are sitting on 11 lakh crores worth of daily liquidity in the banking system. Generally, if you take the last 15 years, the first 10, 12 years, India used to be neutral or negative liquidity in the banking system. The last 2, 3 years, because of demonetization and then, supporting growth during the COVID times and to maintain adequate liquidity, we've had this surplus liquidity framework. But at some stage, liquidity will start getting normalized. So our expectation is that, if you view the future 1 year down the line, but not just today, there is a possibility that not just liquidity will tighten, rates will start moving up. Very low front end part of the yield curve will start moving up, and even spreads will widen. You will be surprised to note that AAA bonds and Government of India bonds more or less borrow money at the same rates. Normally, the spread is 75 basis point higher for corporate India, right? Because the credit spread will always be there. But because of this surplus liquidity, the spreads have compressed. So we thought of creating a contrarian product in a way where the portfolio buys just a simple 5-year Government of India bond or any state development loan. So it's a sovereign product. It has zero credit risk in it because we don't want to play the credit cycle right now when spreads are virtually zero. There is no spread, so why take credit risk? It's a 5-year government sovereign bond, which will automatically mature over the next 5 years. And 1 year, 2 years down the line, its maturity would have come down further. On the other hand, we have designed an interest rate swap. So we buy a 2-year swap. So it neutralizes the duration. So 4 year is the duration on the long side and -2 from the swap side. So the net duration is 2 years today. And as we proceed into the next 1 year, the net duration will come down to 1 year. So that's how we've designed this fund. And there is a segment which says that, yes, we want to plan for the future cycle of interest rates likely to play out. We don't mind having a certain percentage of our portfolio in a product like this, which is one sovereign in nature, where liquidity is not an issue. Remember, corporate bonds, the liquidity can dry out overnight when the cycle turns. When liquidity starts coming down, when the rate cycle turns, even AAA bonds sometimes have an impact cost. So we've created a very conservative fund right now, and the fund is around 2,000 crores in size. I won't say that people are queuing up to invest in that, but discerning investors are asking questions that if I want to hedge against a rising interest rate regime 1, 2, 3 years down the line, if this rising inflation is permanent, and if I want to hedge my fixed income portfolio, then this can be a good product for that.
Kalpen, just one quick follow-up there. Would you reckon that you are being conservative, of course, on that fund, maybe compared to a few other houses who might have version or their own version of a floater fund. So sure. The safety aspect is higher, the return aspect relatively might be lower, but that's the game that you want to play.
Yeah, so the whole idea is in any product that we tend to launch, we always try to say that let's not look at the scenario today. Let's try to see what could it be 1 year down the line, just down the line. Where is the risk? So when the risk manifests, this fund should give the right solution. So it's like building an ark when it is sunny and not when it is raining.
Yep. Munger, and his advice is useful on most occasions, and even this time around, no different. Salonee, just very quickly, one follow-up on that. I know we didn't plan for this, but just wondering, have you seen increased inquiries for floater funds at your end?
So actually, conceptually, I really like floater funds because I think we're close to the bottom of the interest rate cycle, and I see interest rate cycles also because of inflation pressure going up. But I think a lot of times when there is a swap, the returns do not translate to the investors, because when there is a swap, the increase in interest rate does not completely translate to the investors. So as of now, we're not really looking at floater
funds. And that's a view as well. Final conversation, Kalpen, and that's you may have launched the Tiger Fund 15 months ago. It wasn't an old fund offer. Now you have an old fund offer at hand as well. More than anything else, Kalpen, I thought it was really smart, and I'm giving you brownie points for here, by the way. It was really smart marketing. Tell us a bit about what came across this, both from a fund angle and also from the branding angle, because it was really interesting.
To be honest, Niraj, there was no thought of branding it differently or smart marketing intent. I'll tell you the genesis of this thought. We have this fund called DSP. Earlier, it was called DSP Equity Fund, and now the DSP FLEXICAP Fund. It is a fund with 24-year history. It is a fund where I put my first, investment in a DSP product 5 years back. It is a very sensible fund which has generated 5 to 7% excess return over the benchmark over such a long time horizon. Even in the last 5 years, when there are debates of active, passive, whether funds can generate alpha or not, it has generated 2 to 300 basis point of alpha over Nifty 500. It is diversified across sectors and market caps. It has a 12-page transparent investment philosophy document, which we have published and circulated. So investors can ask or learn how do we think about portfolio construction. After all this, it has generated, let's say, 19% long-term CAGR. When I look at the number of investors who have stayed invested for 24 years, it is less than 19. So it is someone asked me this question that you speak so much about this fund, but what have you done in terms of promoting an existing old idea? If your focus is always going to be new ideas, why will old ideas get justice? And that was a very telling comment. And that's where we as a team went back to say that this is a great fund. It has delivered on multiple aspects. Why not just bring it back into focus internally as well as externally? And then we were just debating how do we start talking about it. And suddenly this word came out from nowhere that it is an old fund offer. There is nothing new about it. There is no rocket science about it. It is a very simple idea, and we just want to do justice to it. And that's how we started talking and communicating about it. And with that just small tweak in focus, I'm happy to say that in the last 23 days since we launched the OFO, because it's not an NFO, it's an OFO. And I'm not saying NFOs are bad, because we'll also be doing NFOs wherever we have product gaps. We will be coming with many NFOs in times to come. But since we started talking about this product and its campaign, it is doing roughly 4 times more volumes than what it was doing otherwise. So I think it's just a simple idea, Niraj, and I'm glad you asked this question and you gave me a compliment. And it is an idea for simple long-term multi-cap, flexi-cap investing.
Yeah, before we wrap up, Kalpen, final question really. Within your investment think tank also, when you guys talk about this diversity in market cap, etc., there's a lot of, how do I say, it always is probably, but more so right now, the jury split right down the middle when it comes to the performance, relative return probabilities or possibilities of mid caps and small caps vis-a-vis large caps. So if flexi cap and multi caps were the answer, if when we were maybe a few hundred or a few thousand points lower, is it a good idea to be spreading your bets wide, or are you guys of the opinion that maybe there is safety in the larger numbers or the larger caps?
I would just say that permanently, and this would be my answer permanently, that a FlexiCap fund always, and not because we are doing this OFO campaign right now, permanently a FlexiCap fund makes sense because it will always have a very disciplined ratio of 75 in large caps, 15 to 20 in mid caps, and 5 to 10 in small caps. And more than the market cap, the design is about buying good companies. So a good small cap company is safer than a bad large cap company, is the belief that we've always had. And just to tell you, more evidence of what I'm saying recently, when I purchased a house, I wanted to reduce my equity exposure. I have moved out of either a thematic fund or a market cap focused fund, but not touched my FLEXICAP exposure, because this is something forever. Because the fund manager will keep on navigating. So, for example, in the last month, we have reduced some exposure to small and mid cap, where they've run up a lot in the FLEXICAP portfolio. But the rest of the portfolio, we still like these companies. These companies are still growing at 15 to 25% profit growth rate. Their margins are expanding. So there is no reason to get out of them. They may have some bit of volatility intermittently, but I think we are very comfortable with the category in itself.
Great. Kalpen, as always, really good having you. Thank you so much for taking the time out and being with us today. Appreciate your time.
Thank you, Niraj. Thanks.
Well, those are some views from Kalpen Parekh. Now, let's take this conversation ahead slightly and check in with Salonee on FLEXICAPs. And then, of course, we will also want to understand from her about the SBI offer, which I think ends today, if I'm not wrong, and a bit about maybe a couple of international fund recommendations. Salonee, just a quick word on FLEXICAP funds. Typically, people say that if there is an existing proven investment fund around, don't go for newer names. Any thoughts around this? Well, not an NFO, but as in their own words, the OFO or whatever you call it.
I think I agree with Kalpen. I personally also prefer FLEXICAP funds, especially for conservative and balanced clients, because they get the exposure of small and mid cap, but without it being too large an exposure. Plus, the fund manager has the flexibility, of moving into segments and sectors based on their, thought process. So I think rather than selecting just a large cap, mid cap, small cap, we prefer FLEXICAP funds for our clients. Only for aggressive clients would we look for individual small caps to give them the added exposure. Okay. So I think it's a great idea that they've come out with an OFO, for an existing fund, because you also have a proven track record, so you can see how the fund actually performs over various market cycles.
Yeah, you like that? Have you tried to analyze that one in any fashion whatsoever, or do you believe there are other FLEXICAP funds which you like more?
So I haven't analyzed the DSP FLEXICAP in a lot of detail. We've looked at some other FLEXICAPs in the segment.
Okay, fair call. Now, a couple of things that we wanted to talk with you, Salonee, before we let you go. One of them is NFOs, and like I said, typically the belief is that don't go for an NFO. There are proven there. This one is from the SBI stable. Whether or not people can get in right now, or whether they can get in a few days once it quote unquote starts open again, or because the NFO I believe shuts today. Have you been able to have you looked at that particular product?
Yeah, so we have looked at the SBI Balanced Advantage Fund. It's basically a dynamic asset allocation fund that decides the allocation of debt and equity versus market conditions. My belief is that you should, I would consider an NFO only if it adds a new category or sector to the portfolio. So I feel if, one wants to invest in a balanced advantage fund, there are multiple options, which have a track record across market cycles. And in a balanced advantage fund, especially a dynamic asset allocation fund, it's important to see how it has done across various market cycles. So I would ideally look at investing, in the existing options which have been around for a long time.
Are you at a liberty to be able to tell us a couple of names of balanced advantage funds that you really like?
So one of the balanced advantage funds that I like is the Edelweiss Balanced Advantage Fund, which is essentially a trend following fund. So it looks at moving averages and, the trend helps to determine equity allocation. So if the market is rallying, if the market is going up, they'll actually add to the equity exposure. And if the market starts falling, they'll actually reduce exposure. And what I like is that they actually rebalance it daily. So in case if they feel like, say, for example, March 2020, when the market crashed, the fund fell 16% because they took action very quickly. So I feel in the balanced advantage category, this is one of the funds that I really like.
Okay, final question, Salonee. A bunch of people want to make a beeline for international funds, and maybe diversification is a great idea. Not maybe, I believe diversification is a great idea. and hence our request to you to tell us a couple options on the international fund side, and what kind of investors can go for those funds.
So I think international funds are, as you said, useful for diversification, but from two perspectives. One is, of course, the geographic diversification, and second is also the sector diversification. We have a lot of unicorns in India, but there are a lot of sectors which you cannot participate in India via the public markets, like social media, technology, or electric vehicles, e-commerce, healthcare, etc. So I think from that perspective, that is a gap in most portfolios. So I think it is good to invest internationally to fill that gap. If one is looking for one fund, I'd recommend the Motilal Oswal Nasdaq 100 fund of funds, which essentially mimics the Nasdaq 100, which is which basically includes the top 100 largest non-financial companies. Many of them household names like Amazon, Apple, Microsoft, Alphabet, Facebook, Tesla, etc. In fact, even if you look at it from a diversification perspective, this has actually delivered a CAGR of 28%, over the 5-year period versus 15% for the BSE 500. So from an international, I think this is ETFs and fund of funds are great options, as you begin to invest in international funds. We're also seeing a launch of a lot of new funds, on various geographies, China, Europe, etc. But I'd like to wait and watch on that before investing in those.
Just one final question, Salonee. The fact that this Motilal Oswal Nasdaq fund has had a really good performance over the last 10 years since it's launched. I think our CEO, who's now currently the CEO of NFOS, was telling me about the kind of performance over 10 years for that. Is it past its prime, or there's no way to say that?
I don't think it's past its prime if you're looking for a longer term perspective. If you're talking from maybe a 1-year perspective, then yes, definitely it has run up. So, there could be some scope of correction. But if you're looking at a 5, 10, plus year horizon, then as I mentioned, there are a lot of sectors and companies which we don't have access to. And I think those are sectors of the future. So that is something that you definitely would want to get exposure.
Very good. Salonee, really appreciate you taking the time out and being with us today on the Mutual Fund Show. Thanks so much.
Thank you so much, Niraj. It was my pleasure to be here.
Great having you, viewers. Thanks so much. This leg of the Mutual Fund Show.